cracks are beginning to show in the financial sector on a very, very serious level. And a lot of this is coming from the shadow banking sector, which you'll remember from my videos going back many years where I talked about this quite heavily. Why do you need to know about this? You're probably wondering, how does this affect you? Well, the biggest concern now is not just that most people's pensions have some sort of risk or liability with the shadow banking sector, but also all sorts of other things, mortgages, savings, bank accounts. Everyone seems to be now involved in this shadow banking sector. I want to go over a couple of articles and then I want to go over some data. I've taken loads of notes for you today as to why you need to be aware, whether you are an investor, whether you are invested in the stock market. It doesn't really matter where your money is. If you have money, if you have zero money, don't worry about this video because it doesn't affect you anyway. But if you do have money, savings, pensions, investments, this is going to be a really important video to protect yourself. So let me go over a couple of points then. There was a lot of articles coming out, and they're coming out every day at the moment, and my brain started to notice this pattern. Another one that I saw today, a council in, so this video sort of applies to everyone, doesn't matter which country you're in, but I want to give you one example here. This was a council in the UK, has just ploughed £16 billion of the pension scheme, their pension scheme, into shadow bank lending. This, to me, is absolutely insane, and I'll tell you why in a minute. So this is one of Britain's biggest pension schemes, has invested £16 billion of savers' money into shadow bank loans. And let me just give you some context here, okay? In 2008, the shadow banking sector, which caused the financial crash, was $60 trillion globally. Okay, so you bear that in mind, $60 trillion. Today, as I record this in 2025, it is $240 trillion. Do the math on that. That is a 4x increase in the shadow banking sector and the risk as well that comes along with it. It is very lightly regulated and there's massive cracks forming. In fact, there's 2 or 3 large companies that have just defaulted with owing billions, absolutely billions, which again is a massive default. So now you've got some context here. The local government pension scheme, this is the LGPS, which looks after the retirement savings of 6 million local council workers, has invested this sum into the troubled private credit market. A freedom of information request has shown us. So this is recently, they've done this. Private credit is a $3 trillion market that involves money managers lending to companies. Why? Because these companies can't get loans because they are deemed unsuitable, or they just can't. There's a lot of reasons, actually, we can go into that later, but they couldn't get loans from a bank, so they go to these the shadow banking sector, and these private firms give these loans, and they're not subject to the same regulations as the bank is. So there's a lack of transparency there, huge issues. And investors have been on high alert about this sector following the bankruptcies of these US businesses. So let me tell you what they were. So one of them you might have heard of. This was the Ohio-based car part supplier called First Brands. This collapsed last month with liabilities of $11.6 billion. So huge numbers here. Also, Tricolor, this is a motoring dealer. This is the 3rd largest car retailer in Texas and California, also just filed for bankruptcy. They owe more than $1 billion to 25,000 creditors. And yet, this government scheme, this council scheme, has just invested all of this money into this sector. It is absolutely insane what these people are doing. Deutsche Bank has just raised concerns that First Brands could be the canary in the coal mine for these challenges that they see coming. Earlier this week, the Financial Conduct Authority, the FCA of the United Kingdom, said it was vigilant of the risks and people should be aware. This goes on and on and on. So local government pensions have invested around £24 billion into these private equity schemes, even though the FCA has just said be wary. They've just invested. Let me show you a graph here, which is quite relevant. So this is private equity here. You got your Blackstone, KKR, Ares, Apollo, etc. They have all crashed down. Look at the drop as the S&P has climbed. So let me give you a bit of context here. I think the context is important because I've been fielding so many questions in the private community this week. Every day, in fact, I've never had so many questions as I have this week. And I am personally answering every single one of you. I'm getting through them all. So people are saying, Neil, I don't get it. Why are all of the big funds crashing, or why is the S&P climbing? Why is the FTSE climbing? Why is everything climbing? Why is gold and silver prices exploding, which we'll talk about in a second? And then the question was, why did the crypto market crash this week? So I've covered all of these questions. But the main thing you need to be aware of is you're seeing capital fleeing now. And it always begins with the smart money first. So the smart money is fleeing. We've also got this AI stock bubble. And it is a bubble that has formed. And it is massive. And it's only a matter of time until it implodes. We've got parallels from previous crises. So again, be wary of that. Be careful of that. If you get my Friday newsletter, I'll let you, you've probably seen the warnings. Where there's opportunity, where there's risk, etc. You just got to be very, very careful. One of the things I've been talking about for years is obviously gold and silver is very good hedge, very good protection for you, for your money. And in fact, while we're on the topic, and we'll come back to this in a second, let's just look at the gold and silver prices here. So look at this over the last year. Gold has gone up. It's actually broken now $4,000 an ounce. It's gone up 54% in the last year. What about silver then? Silver as well has gone up 62% in the last year. I don't know if you saw my post, but I let everybody know about this in April. This was April 19th. I told everyone it's just past 100 to 1. Silver is the buy. Then September 23rd, I talked about the supply crunch. Okay, so a lot of you should be aware of all of this anyway. Now, there's one thing I always talk about, and that is monetary metals. So they are sponsoring today's video. And I highly recommend, I'll put the link below in the description, I highly recommend looking at monetary metals. It's a really unique opportunity for you actually to protect yourself against a lot of the things that are happening. So if you already own gold or silver, great, that this can help. If you don't, then definitely look at it. And I'll tell you why. If you think gold prices are hitting new highs again this year, right? What if there were a way to make your gold and your silver, but your gold work for you rather than it just sitting there idle and not earning anything, right? And that's what this company does, Monetary Metals. They're in my course as well, if you've taken the gold and silver course. The CEO is one of the interviews. It's a fascinating interview showing the whole model on how they do it, which is why I'm invested into it, because it's such a good model. They've created a groundbreaking way for clients to earn a yield on their gold, paid in gold. And you might say, well, how on earth do they do that, Neil? Well, I'll tell you in a second, actually. So you don't have to sell your metal. You don't have to convert it into cash. You simply earn ounces based on the metal itself. It's a very transparent marketplace. It leases then this metal to businesses. So you think like the jewelry industry, you think some of these big industries that need the metal, but they don't want to buy the whole metal because it will cost them a lot of money. So they lease the metal and it's constantly turning, right? So this inventory is turning. It's a really fascinating model, which they've really cornered the market on. So these businesses use it very productively, jewelers, refiners, etc. And then the returns on those leases go back to you, which is paid in gold. So it's a simple sound, it's a fully asset-backed model. I've done the research on it. I've asked the tough questions. I've looked at the insurance policy. I've looked at the risk liability, and I stand behind it. It's designed for people who understand real money and want to grow their wealth in an honest way. So it's all about building real sustainable wealth in this asset. So whether you already own gold or you're looking to start, you can actually fund your account with metals that you own, or you can buy metals through them, not at 20% over spot, but within 1% of the spot price. So you can join thousands of people today already earning a real yield in gold every month. So I'll put the link below in the description and the pinned comment, but it is monetary-metals.com/NMW, and that's how you can earn a yield on it. Okay, now let's go back to, where did we get to on this? Okay, let's go back to the chart then. So this is what we're seeing. We're seeing the S&P rising. We're seeing gold prices rising. We're seeing silver pricing rising. We've seen the crypto market rising, except for the blip that took place this week. And that was really a cascade effect. I could have made a video on it, but some of you like crypto, some of you don't. So it really caused this cascade effect with margin calls that were just getting, it went. And this is actually, let me give you this example. This is what you're going to see when the shadow banking sector collapses as well. It's similar to 08, similar to the 70s, similar to 2000. You're just going to see it just, margin calls, people are going to be rushing out, liquidity crises. You're going to see this is going to be much bigger than 08 when it actually happens. It is going to be absolutely huge. Shares in Apollo, Blackstone, KKR, Ares, all of these money management giants that have really pioneered this industry, their stocks have fallen by 10% in the last month. Now you've got to ask, why is that? Well, it's because there's concerns in the sector. All the smart investors are already getting out of those and they're going to safety. And that is what you need to look at as well. Again, I'm not giving you financial advice because this is obviously social media, but you really need to look at your portfolios right now. And you need to be careful. You need to say, am I exposed to any high risk here? If you are, maybe look at diversifying a little bit. Yeah, I mentioned the AI bubble, stock bubble as well. There's just so many of these articles that have been coming out. I mean, this tells you there's something going on when there's all these articles non-stop. Stock markets hitting record highs, price of gold and Bitcoin exploding. This is an article I was just reading today. Alan Greenspan called this irrational exuberance. Investors have started selling off shares in some of the world's largest money managers, and this is due to the exposure. And yet, British councils are investing into them, seeing them as cheap because they've gone down so much. This is a crisis just waiting to happen, basically. The FCA last week also warned of this, be vigilant over them. All of these collapses we've seen, there's 3 of them now. But what you need to know is the asset managers have turned themselves into corporate bankers. They're lending out lots of money to businesses now without the stringent regulations. The interest rates are often 10% or more with another couple of points in arrangement fees. I mean, you've got to be, as a company, making a lot of money just to be able to afford that 10% plus the 2% in arrangement fees. This is significant capital that we're talking about. And a lot of these businesses just can't, they're not making that much in profit. It's very lightly regulated. I don't know if you remember that video I made years ago where it was somewhat tongue-in-cheek, but I said these BTOs, bespoke tranche opportunities, and there was CDOs, collateralized debt obligations, and they basically were banned, right? The bundles, they banned them. So what they did, they just rebranded them to something else, and that is why you've got this massive bubble now that's risen. And here we go. This is the AI bubble, actually. Let me show you this chart. So this is the AI bubble now. Look at these. Look at the size of these companies. Broadcom, 1.6 trillion. Oracle, 933 billion. Nvidia, 4.5 trillion. Yeah, now a couple of things I wanted to talk about here then. I'm going to go over all of my notes now. I know I just went over a load of stuff and articles, but I want to go over my notes. So I wanted to sort of do the parallel of 2025 to 2008. Okay, so I've told you one of them. And that was the 60 trillion then is 240 trillion now. So huge, absolutely huge. Private credit then has gone from 300 billion in 2008 to 2.1 trillion last year. We don't have the numbers for this year. And a lot of that is because the companies, their balance sheet wasn't strong enough for normal banks. So they take these not dodgy loans, but high risk loans. Leverage as well. This is over 1 trillion. These are AAA tranches again. Now, does that ring a bell from 2008? That is what caused the crash last time, and it's even bigger. Repo market. This was it was 2019. I think it spiked 10% overnight, and then the Fed had to intervene and solve that. Non-bank mortgage lenders. This was today in the US specifically, 70% or more of mortgages come from non-banks. This, ladies and gents, is just a crisis waiting to happen. Derivatives, counterparty risk, over 600 trillion. 600 trillion is the derivatives market. If that goes, forget it. I mean, remember AIG just before Lehman Brothers. If that goes, forget it. I mean, everything's going to be wiped out. There's just no way to stop it. So in 2008, it was Lehman Brothers, it was Bear Stearns, it was AIG. They were the three big ones. Today, it's your BlackRock, Vanguard, Apollo, Blackstone, and the big hedge funds. Because think about it, they control the pension funds, there's mortgages, corporate debt, real estate, ETFs. I mean, they control everything. Let me see if there's any more notes to go over here. Okay, I put where you might see the biggest issues first. I think private credit, large non-bank mortgages, repo spikes, and commercial real estate. So the big difference was, if you think of 2008, what was that? It was subprime homeowners, right? But this one, I think, is going to be a lot bigger. I think it's going to be higher up as well. Corporations, funds, pensions, even governments. The UK government is foolish, these councils, for what they've invested in. They're absolute fools for thinking this is an opportunity. And I was reading, you know how they always do it. Would you like to respond to this? Blah, blah, blah. One of them actually responded and said that it was basically like, not my problem. He was the head of the fund, right? Not my problem. We use expert debt managers and brokers, and they tell us how to invest. Well, that's a fool's errand. You don't, right? Here's how it works. You either pay a fee or you are the fee. So if you're not paying for management and you're not paying for the fees, you are the fee. They're not going to put you in the best, safest assets. You give them tens of billions, hundreds of billions, and say, hey, look, we need to invest this. In fact, how much, let me just clarify, how much was it again? They put in, this was what they've just plowed in. This is on top of, so 16 billion is what they've just plowed in, on top of what they've already plowed in. Thinking that these asset managers are going to lead them right. They're not. They're not. They never do. They're going to look after themselves. What makes me a massive commission? They're definitely not looking after you with your pensions, which are being invested. I mean, this is what I've been saying for a while. I even did those documentaries saying it's a massive Ponzi scheme, these pension schemes. And that's why you're seeing people pulling their money out of these pension schemes like you've never seen at the minute. So again, think about this. Have a think about what is right for you. But again, I'm just here to tell you what I see. And when I see risks, I pass that on to you as my subscribers here. I want you to be best protected. So really look at that. And also do look at the sponsor of the video, Monetary Metals. I do stand by them. People email me, do you stand by them? I do. I only put sponsors on the channel that I've verified myself. I've checked them out, and I stand by them. So have a look at them. Apart from that, thanks for being a subscriber. Take care. God bless. I'll see you on the next one.